February 1998, Waste Management, Inc., the largest waste disposal company on the planet, steps before the financial world and makes a confession. Its profits, reported over 5 consecutive years, are fiction. $1.7 billion in earnings, fabricated, never real. The stock collapses. More than 33% of its value vanishes in weeks. Shareholders, pension funds, retirement accounts, ordinary families lose over $6 billion. It is, at that moment, the largest restatement of earnings in American corporate history. But the executives who orchestrated it? They had been cashing out. The founder sold millions in stock just weeks before the truth emerged. He even donated inflated shares to his alma mater to fund a building with his name on it. While everyone else absorbed the blow, the men at the top walked away richer. This is the story of how the people running America's trash empire turned their own books into garbage, and how an entire system looked the other way. Empire building Dean. Buntrock didn't come from wealth. Born in 1931 in South Dakota, he grew up working for his father's small hauling operation. After his father-in-law, a partner in a Chicago garbage business, died unexpectedly, Buntrock stepped in. That decision changed everything. In 1968, he partnered with Wayne Huizenga and Larry Beck to form Waste Management, Incorporated. They went public in 1971 with just $16 million in revenue. What followed was extraordinary. Over the next 20 years, the company grew at 36% annually. In both revenue and net income, they acquired haulers and landfill operators at a blistering pace, sometimes completing 200 acquisitions in a single year. By 1991, revenue exceeded $7.5 billion. Buntrock was celebrated, honored by the Horatio Alger Association, seated on the boards of major public companies. He embodied the self-made American ideal. His credibility was unassailable. But by the early 1990s, the engine was sputtering. Environmental regulations tightened. Landfill permits grew expensive. Competition intensified. International ventures underperformed. Waste management was no longer the growth story Wall Street loved. Buntrock had no interest in telling that truth. Fraud mechanism. Explained clearly, the mechanics were deceptively simple. The core strategy: make expenses disappear so earnings looked higher than reality. The primary tool was depreciation manipulation. Waste management owned thousands of garbage trucks. Operating divisions depreciated each truck over 8 years with zero salvage value. But at the corporate level, senior management quietly recorded top-level adjustments, extending the useful life to 12 years and assigning an unsupported salvage value of $30,000. Think of it this way. A truck costing $200,000 depreciated over 8 years means $25,000 in annual expense. Stretch that to 12 years and add salvage value, and the annual cost drops dramatically. Multiply across thousands of trucks, and hundreds of millions in expenses vanish from the books. But they didn't stop there. Management refused to write down landfill values as they filled with waste. They left failed permitting projects on the balance sheet as if those dead investments still held value. When a permitting effort collapsed, they bundled costs into active projects to hide them. They also raided environmental liability reserves, money set aside for potential cleanups, and used it to cover unrelated operating expenses. Imagine draining your emergency savings to pay for groceries, then telling everyone the account is still full. Every quarter, Buntrock's team set earnings targets. When actual numbers fell short, they fabricated adjustments to fill the gap. The SEC later described these as made-up numbers. They called the concealment process netting, using one-time gains to quietly erase accumulated errors. Over the fraud's duration, netting erased approximately $490 million in expenses. Red flags. Someone did notice. Arthur Andersen, Waste Management's own auditor and one of the most respected accounting firms in the world, identified problems early. In 1992, Andersen flagged that top-level adjustments were obscuring the true performance of operating units. They recommended the practice stop. Management refused. Each year, Andersen prepared corrections that should have been made. Each year, management rejected them. Instead, the firm entered a secret agreement with management, a 4-page document called the Summary of Action Steps, outlining 32 changes needed to reach what Andersen called a minimum level of acceptable accounting. The company never complied. Compliance would have prevented executives from hitting targets and earning bonuses. Even the general counsel reportedly questioned whether this is securities fraud. In 1995, an internal study was commissioned to determine actual truck values. The results contradicted management's assumptions. CFO James Koenig's response was immediate. Stop the research, destroy all copies, delete it from the author's computer. The findings were buried permanently. System failure analysis. Why did this persist for 5 years? The answer lies in intertwined incentives and institutional failure. Arthur Andersen wasn't just the auditor, it was a talent pipeline. Every CFO and CAO in the company's history had come from Andersen. Former Andersen employees filled key financial positions throughout the organization. The lines between watchdog and insider were erased. Andersen also earned substantial non-audit fees. Management capped audit fees but dangled lucrative special work. The economic incentive to preserve the relationship overwhelmed the duty to protect investors. Meanwhile, the manipulations were centralized at headquarters and hidden from operating divisions. The field never knew. Thousands of honest employees had no visibility into what was happening above them, and Wall Street's quarterly expectations created relentless pressure. The market rewarded consistency. Any earnings stumble triggered a sell-off. The system incentivized smoothness over truth. Collapse. The unraveling began in 1997. Shareholder pressure forced out old management. A new CEO was brought in and ordered an accounting review. He lasted 4 months. He reportedly called the accounting spooky and resigned. The review continued. In February 1998, Waste Management announced the restatement. Every year from 1992 through early 1997 had to be revised. In some years, net income had been overstated by more than 75%. In 1996, the company reported a profit. The real number was a loss. The stock plummeted. $6 billion in shareholder value destroyed. In July 1998, the crippled company was acquired by smaller rival USA Waste Services. The Oak Brook headquarters was shuttered. 1,500 of 1,700 employees were terminated. Human cost. Those 1,500 people had no part in the fraud. They were accountants, administrators, support staff who trusted the company they worked for. They lost their livelihoods because of decisions made in closed rooms by 6 men. Pension funds, retirement accounts, individual investors, all devastated. A $457 million class action settlement was eventually reached, but that was pennies against the scale of actual losses. Arthur Andersen paid a $7 million SEC fine, then the largest ever imposed on an accounting firm. But the real reckoning came later. Andersen's pattern of audit failure, repeated with Enron, led to its criminal conviction and dissolution. The roots of that collapse trace directly to waste management. Psychological autopsy Buntrock didn't start as a fraudster. He built something real. For 20 years, the growth was genuine, but identity and performance fused together. He wasn't just running the company, he was the company. When the business slowed, he couldn't accept it publicly. The SEC stated the fraud was motivated by greed and a desire to preserve professional and social status. But it was likely more specific, the terror of being seen as diminished. The manipulations started small, but each quarter's fabrication became the floor for the next. Chief Accounting Officer Thomas Howe described it internally as a one-off problem. Each year's fiction had to be replaced by a bigger fiction. The hole only deepened. Buntrock pocketed nearly $17 million in ill-gotten gains. Yet in the final weeks before exposure, he was donating inflated stock and putting his name on buildings. He wasn't behaving like a man who believed he was committing a crime. The rationalization was total. Reflective, ending waste management exists today as a financial giant. The market moved on. Most investors have never heard of the restatement, but the case left a mark. It was one of the dominoes that fell before Enron, before WorldCom, before Sarbanes-Oxley reshaped corporate accountability. It proved that auditors, boards, and regulators could fail simultaneously and silently. The most dangerous frauds don't happen in flashy industries. They happen in the boring ones, the places nobody thinks to look. Because the moment everyone assumes a business is too dull to deceive, the conditions for deception are already in place.